The most important driver of investment returns is asset allocation. This is how much money you put into shares, into bonds, into commodities. By investing cross-asset, you reduce the overall volatility of your portfolio and reduce your risk. Also now it's very easy and cheap to buy a whole market like the FTSE 100 or a very large bond index through cheap tracking ETFs. So this also keeps your costs down. So in this video, we're going to talk in detail about asset allocation and how to do it yourself. You have to be honest with yourself. How much time can you realistically spend on investment decisions? Do you have time to focus on the minutiae of every single company in which you could invest? Or would your time be better spent looking at the big picture? Research shows that the most important driver of investment returns is your asset allocation policy. This paper, published by Ibbotson and Kaplan almost 20 years ago, looked at that question in detail. What they found was that over time 90% of the variability of fund returns came from asset allocation. If you look at the variation between funds, it was only 40%. If you look at the level of returns, which is what we should care about as investors, more than 100% of the level of returns could be explained by your asset allocation policy. In fact, I think that stock picking is a complete waste of time. Let me show you why. If you invest in single stocks, you'd better read those annual reports. Here's the annual report for BT Group in 2016. If you read it and you got as far as page 121 of a 200-page report, you'd be comforted by the fact that they continue to monitor their operations in Italy and they've improved the control environment. But in January, there were allegations of false accounting in BT's Italian business, and in the space of a day, the share price fell by 21%. Now, there's no way you could have known that would happen. There was no hint of it in the annual report, but that's the kind of risk you face if you buy single stocks. On the same day that BT fell 21%, the FTSE didn't fall as much because it's diversified. It's an average of 100 different stocks. And you'd have to have catastrophic news to drive down the FTSE by 21%. By buying the index, you instantly diversify your investment. Take a look at the S&P SPIVA website. You'll find the link at the bottom of this screen. Over a period of 5 years, 80% of funds underperform their European index. Highly intelligent and highly resourced professional investors can't beat the index, and neither can you. So if you can't beat the index, buy the index. Nowadays it's very easy to buy the whole market, and you can do so cheaply. Here's a sample of exchange traded funds where you can track an entire index, almost a whole market in one go. I've sorted it by volatility, so the most risky stuff is at the top and the least risky stuff is at the bottom. And for each fund I've shown the asset type. You can track property, many different flavors of equity, such as emerging markets or developed markets or large cap companies, or you can track the bond market, high yield bonds, inflation bonds, investment grade bonds and government bonds. And you trade the ETF just as if it was a single stock. This is the annual cost of that sample of ETFs, expressed as a total expense ratio. So let's say you invest £1,000. The cheapest ETFs will charge you only 0.07% per year. That means on £1,000, you pay less than £1, you pay 70 pence per year in management costs. The average expense ratio, the median, is 0.3%, so you pay £3 per year on a £1,000 investment. Compare that with an actively managed fund, where you pay a fund manager to choose your investments for you. There you could pay £20 per year. And remember, these guys just can't beat the market. So if you're careful with your risk and you invest time learning the craft, you'd be better off doing it yourself. If you want to do asset allocation, you have to think macro, not micro. By that I mean you have to think top down. Economic growth is what drives earnings for companies. That means you have to keep an eye on GDP or any of the indicators which give you a hint which way GDP is going. That's why we spend so much time talking about things like the Purchasing Managers Index, because that's a leading indicator of GDP, economic growth. And that in turn drives the earnings for companies. When the earnings go up, the share prices go up. Employment numbers and wage growth are also very important. In the UK and the US, we're service-driven economies, and that means disposable income is very important. So the thing to watch is the race between wage growth and inflation. If real wages are falling, that's wage growth minus inflation, then households will have less disposable income, and that'll be a drag on the economy. Another macro factor to watch is central bank policy. Here's the Monetary Policy Committee. All of their deliberations are published. All you have to do is look at the Bank of England website or subscribe to our Twitter feed. They go to great pains to explain their policy decisions and what they consider to be the state of the economy. Use that resource. And of course, you have to watch politics. How much money is the US president going to spend on infrastructure, and will that spill over into UK growth? Oh, wait a minute, I think we've got the wrong picture. Ah yes, here we go. Remember, the US is still the dominant driving factor in global markets. They have the biggest economy and by far the biggest stock market. So as a driver of global markets, they're the one to watch. If you're doing asset allocation, you have to diversify your portfolio by buying different asset types. Let me show you what I mean. Here we've got 3 stock indices, the FTSE 100, the DAX index for Germany, and the S&P 500 index, which tracks US stocks. They're really very similar, aren't they? They track one another very closely. So why buy all 3? Why not just buy one of them? So let's say you buy £1 of the FTSE 100, and you also buy £1 of the S&P 500. The total risk of your investment is just like you'd bought £2 of the FTSE 100. There's no diversification benefit because they're so highly correlated. They move up and down together. Now let's look across asset types. Here are 2 ETFs. One tracks the FTSE 100 stock index, the other one tracks a UK government bond index. And you can see very clearly that they don't follow one another. And that means you get diversification benefits from investing in both. So if we buy £1 of the FTSE 100 and £1's worth of gilts, that's UK government bonds, the total risk of our investment is less than the £2 of the FTSE 100 or £2 of gilts. As much as I hate the word, there's synergy here. On the PensionCraft website, we have a diversification tool. The table on the left shows the ETFs which we plotted on the right. Don't worry about the details here. The key thing to look at is the equity-equity correlations. That's the triangle in red. If you look at any pair of equity trackers, their correlation will be very high. And in turn, that means they give you very little diversification benefit. Whereas if you look at the equity bond correlations, they're often negative. That means they wiggle up and down in different directions. And the net effect of that is to reduce the volatility and the risk of your investment. So the question is, how much do you put into each different asset type? What are the allocation proportions? Generally, the more shares you have in your portfolio, the greater the risk. So you have to decide on your risk appetite. If you like a lot of risk, you'd put all of your money into equities. If you're very risk averse, you'd put all of your money into bonds. And of course, as you age, you take less risk because you've got less time to recover from mistakes if the markets crash. So a commonly used rule of thumb is to put 60% minus your age into shares. That means that as you age, you dial down the risk on your portfolio. As a 20-year-old, you'd put 40% of your investments into equity and 60% into bonds. But gradually you reduce the equity until at age 60, you have no equity investment and 100% invested in bonds. Another approach, which is very interesting, is called inverse risk weighting. The riskier an asset type, the less you have of it in your portfolio. That means your portfolio will be dominated by safe stuff like bonds. So for example, the volatility or the risk of the FTSE 100 is 20% per year. That's the typical annual move, up or down, of the FTSE 100. The volatility of UK gilts is much lower, around 5%. And that's why gilts get a much higher weighting in an inverse risk portfolio. Those volatilities would give you an 80% weighting for gilts and a 20% weighting for the FTSE 100. But you don't just set your weights and go away. Allocation is a dynamic process. So using our previous example, where the weights were 20%, 80%, a few months pass and the prices of the indices move. Let's say the FTSE's rallied very strongly and it outperformed gilts. Now the weight of the FTSE is 25% rather than 20%, and the UK gilts have fallen to 75%. In that case, you'd have to sell some of the FTSE 100 and buy some more gilts. We'd say that you've rebalanced your portfolio. You're back in line with your asset allocation strategy. But you shouldn't do this too frequently, otherwise you're going to rack up a lot of trading costs. It's a difficult process because you have to sell the best performers and buy the worst performers, which seems rather counterintuitive. But if you're going to stick to your asset allocation strategy, you have to rebalance your portfolio. But I think the key thing about asset allocation is that you can make it very simple. Here's one simple approach to asset allocation. You should be able to count the number of funds in which you invest on the fingers of one hand. Always look out for very low fees. These will be published as a TER or total expense ratio. You should try and avoid paying more than 0.3% per year. The most important determinant of risk is the proportion of equity in your portfolio. As you get older, you should be dialing that down. The funds that you choose should be big and liquid. That means you can trade them easily. Try to go for funds which are larger than £20 million. You have to diversify your portfolio by investing in different asset types. That could be equity and bonds, or perhaps even property and commodities. Try to get a handle on your risk appetite and adjust your equity bond ratio to suit that appetite. Once you've made your investment and there's a small sell-off, don't sell your holdings. And when you enter the market, don't try and time your entry. But once you have an allocation strategy, stick to it. And that means you have to rebalance your portfolio when market movements make it drift away from your strategy. I don't think anyone can say it as well as Warren Buffett. This is his letter to shareholders in 2013. It's on page 20 if you want to look it up. He says that most investors don't know enough about specific businesses to predict what they're going to earn in future. But they don't need to. Their job isn't to pick winners. They can just buy the whole S&P 500 index. But once you buy the index, buy it forever. Accumulate your shares over a long period of time and don't sell when there's bad news. And most important of all is to keep your costs minimal. It doesn't matter if you're an unsophisticated investor as long as you admit your shortcomings. Don't pretend to be a stock picker, track the index. And by doing that, you can outperform many knowledgeable professionals. Here's a legal bit. This is not a recommendation. If you want a recommendation tailored to your specific circumstances, you should seek independent financial advice. Do you agree with us? Do you think stock picking is a waste of time? We'd love to know. Tweet us at PensionCraft, message us on Facebook, and if you want to see more of our videos, subscribe to our channel.